We're going to take a little different approach on some of these macro charts, and I will admit, I got a little bit of snarkiness going on. I don't know if I was just feeling spicy because the weather's so bad outside, but we've got some unique takes versus what we've done in the past on some of the macro side. But give a little bit of a review. Those who weren't able to tune in to engage, both Eddie Lehner, who is our CEO, and myself, and I swear we did not compare notes. I didn't know what he was going to be presenting on. Eddie spent a fair amount of time talking about an essay that was written by Marc Andreessen. Marc Andreessen is a venture capital titan, if you will, resides out on the West Coast, and he's taken a number of very large startups public and made a ton of money doing it. He's quite good within the space. He wrote an essay titled "It's Time to Build," and this essay was actually written over a year ago at this point. Eddie kind of harkened back to that approach, which is we've got all these technological innovations, and I'm definitely paraphrasing here, but we've got all of these technological innovations. You know, we've got cryptocurrencies that are growing, we've got electric vehicles that are growing, we've got the metaverse that's a brand new thing, and yet we still have bridges that are crumbling. We have, you know, shortages of energy sources. We have countries running out of food in certain situations. And I think the essence of what Eddie talked about, and also what I talked about, which this is one of my slides, is I think there needs to be a slight, mean reversion back to this old economy. So I've dubbed it revenge of the old economy, which is all of those digital improvements and technological advancements are all well and good. And I think they are absolutely going to be part of our future over the coming 5, 10, maybe 30 years. But I think we've forgotten about building blocks of how we ultimately get there. You know, we can't have electric vehicles and charging stations without more copper. We can't have electric vehicle batteries without more lithium, cobalt, nickel. And all of those things are pretty foundational to our economy. And I would say we're finding out, and what we're witnessing really globally is lack of investment, lack of focus, and lack of employees being in those places has caused situations where a lot of those building blocks, we're running low on materials, we're running low on energy, and they've almost been so pushed to the side that they're almost 4-letter words. And I think we probably need to revisit some of those, because as you'll see here in the coming slides, the resulting effect is less availability of materials, higher prices of core goods, being food, energy, shelter. So I think there really is going to be a reversion back to a lot of this. And I will say I changed out one of the images down in the bottom right corner, but I think it's timely because as we sit here today on February 3rd, the price of Facebook, which actually changed its name last year to Meta, they reported earnings last night and they are down, I think 26, 27% today. It's the biggest move lower in the history of the company. And one of the big critiques is they're spending billions and billions of dollars on the metaverse. And yet, their growth rate just isn't all that strong. So anybody who owns Facebook, I sincerely apologize. It is not fun losing money, but I thought it was a funny little image where it kind of fits into the theme of, Mark Zuckerberg coming out and saying we're changing our name back to Facebook from Meta, because maybe Meta got a little too far into the future for now. That being said, I mentioned Eddie's discussion around this Marc Andreessen essay, and I know that Eddie is from the great city of Cleveland, Ohio, which houses some of the best rappers of our time, whether it be Kid Cudi or Machine Gun Kelly, or you go back to the late 90s, you got Bone Thugs and Harmony. I knew that all of them were from Cleveland, and maybe they've got close ties to Eddie, but it almost seems as though Kanye West may have been tuning into Eddie's presentation on Engage, because this is actually from Kanye West's Instagram earlier this week. And again, it kind of fits into this revenge of the old economy, if you will. It looks like a note that maybe he put on his dinner table, basically next for a waiter potentially. But it says, "My focus is on building real products in the real world, real food, real clothes, real shelter. Do not ask me to do a," and then I covered up the word that he used with a little aluminum, but don't ask me to do an NFT, which is a non-fungible token. It's very much so part of this digital world. But I thought it was funny because it really did harken back to this idea that we kind of need to improve things in the physical world as we're transitioning into this futuristic world of the digital economy, which may be the metaverse, it may be NFTs, cryptocurrency, things like that. But all of those things take grassroots products, things like crude oil, things like natural gas, nuclear energy, metals, whether it's base metals, ferrous metals. But I thought all of this fit together in a fairly interesting way, and I don't follow Kanye West, but somebody tagged this on Twitter, and I thought I had to use it. That being said,
I think there's an engage background in the background. You're right. You cannot confirm or deny that Kanye West intended engage.
Yeah, exactly. So with that being said, this is a quick look at the PMI data, and I don't know if I'm blocking it, but I am on my own screen, so I'm going to move this over here. But you look at the global basis, and for the most part, every region of the world is in expansionary territory. So as we think about the survey and the resulting response that many of you see things as being stronger for this year, I would say that is echoed in most regions of the world. A couple of small items that I would want to point out is emerging markets are taking it a little bit on the chin. I would say generally in inflationary environments, emerging markets tend to be the ones that get hit a little harder. Their currencies tend to have wider fluctuations. So emerging markets have moved into yellow territory, kind of weakening territory. Brazil has weakened a fair amount on a month-over-month basis. Even China has dipped below the 50 mark. But for the most part, as we look across the world, manufacturing activity looks quite good. I mentioned inflation. Inflation was referenced within a lot of our surveys and availability of goods. And this just comes back to when we have a lack of availability of things like food products, energy, metals. This is the resulting chart you get. And this is the Bloomberg Commodity Spot Index. So this is a basket across agricultural products, base metals, ferrous metals, precious metals, which would be gold and silver, and energy products. And you can see that going all the way back to the beginning of this index, we've kind of blown through the 2010, 2011 highs when China was on its super cycle. So this is what happens when we forget to invest or fail to invest in this old economy. We get situations like this where you actually have an energy crisis in parts of the world. You have the potential for a food crisis in parts of the world. And again, I'm not trying to be doomsday. I think all of this is very encouraging for Ryerson and for our industry, because there should be a rejuvenation of investment in a lot of these things. We talked about this chart in the past, but this again is looking at the blue line being US natural gas prices against European prices. And again, some of you don't have operations in Europe, but it's worth noting the fact that within Europe, they're still in a very tight environment from an energy standpoint. The price of natural gas right now is roughly 7 times where we are. It had been close to about 20 times. We've got some real issues over there where they, not just geopolitical, but even without the Russia-Ukraine situation, they've got a situation where they're beginning to reopen their economy and demand is coming back online at a faster clip than what their supply side is supporting. And there are some real instances of blackouts and shutdowns or curtailments of production facilities. And the reason why this is noteworthy is, I think we've mentioned this in prior couple of shows, there have been a couple aluminum smelters that have curtailed production because of increased energy costs. So I think we certainly want to be cognizant of this fact, because right now it's primarily in the European region where the energy issues are. I think we're starting to see a little bit of the United States seeing some issues. Take this current storm we've got across the country. There are some rumblings of power outages in Texas, rumblings of power outages in Tennessee. And even if you go into the Northeast is beginning to produce electricity with crude oil, which is a pretty unique phenomenon. But it does kind of give credence to this idea that fossil fuels are not going away just yet. That's not to say that in 10 years, 20 years, we can't phase these things out in a complete way. But I think in the transitionary period, we've kind of forgotten that we do have a fairly heavy reliance on a lot of these things. And again, why should you care about energy prices? This is looking at a 1-year chart of WTI crude oil, which I updated this chart this morning, and the price is 88.63. And just in the last couple hours since I've updated it, the price of WTI crude oil has gone above $90 a barrel. So it continues to see increases. There are a lot of analysts out there who are saying $100, $125 crude oil. And, maybe a more direct rationale as to why you might want to care about this is overlaid against this is the price of aluminum. And this is in US dollars per metric ton. But you can see there's a pretty strong relationship and correlation between where the price of energy is going and ultimately where the price of metals are going. And it makes sense because a lot of these metals are very energy intensive. If the cost of energy is moving up, well, and the cost to produce whatever product it is also going up. And this isn't just true of metals. This is probably going to be true of logistics. It's going to be true of making pretty much anything, whether it's food or metallic. And I found this combination of headlines very interesting. Again, it's a little snarky. I apologize. Up in the top left, what we've got is from January 1st, Germany announced in late December that by the end of last year, they were going to close down the remainder of their nuclear power plants. And this is a little political, but I was always under the impression, and I'm not an energy expert, but I was always under the impression that on a relative basis, in terms of baseline energy sources, I was always under the impression that nuclear was a very green-ish energy source. Germany clearly disagreed with me, had different experts giving them opinions, and they actually closed down their nuclear power plants. So they had 3 of them. And pretty interesting scenario because you're in the middle of winter, you're already in a situation where your natural gas prices are multiple times what they are in the United States. And yet they're reducing supplies of power. Kind of an interesting approach, and I'm not trying to say what's right, wrong, or anything. What's fascinating is fast forward from end of December, early January to now, the bottom right corner is a headline from just yesterday. And the European Union is now proposing rules to allow for some natural gas and nuclear investments to be considered as green. Now, I don't know the details of what makes a nuclear power plant green versus not green, but I think in terms of some of these policies that have been put in place that are in an effort to be green or to move towards an ESG impact type scenario, they are causing some of the issues, at least in the short term, where we're seeing very, very tight supplies of crude oil, natural gas, even coal. And because of that, that's why we're seeing on a global basis rolling blackouts. We're seeing some protests. I can't remember if I mentioned this in prior couple of Joes or maybe in Engage, but Kazakhstan had a massive protest just a couple weeks ago where they burned the president's mansion, his palace. And it was over energy, not over COVID. So very interesting stuff. This is real deal type stuff. We're getting to the core of basic needs in terms of food and energy. And on the food side, it's kind of a lot of the same in terms of price and availability. This is the price of ammonia, specifically within the Corn Belt region of the United States, so-called Iowa, Illinois, Indiana. You can see it's gone parabolic. The same way a lot of other charts that we've watched within the metals world go parabolic. Ammonia is doing the same thing. So what does that ultimately translate to? Well, it probably translates to higher fertilizer costs, which increase the cost of making food or farming. So all of these things are somewhat interconnected, and the closer we get to reopening the global economy, the better that demand side of the equation is going to be. And I just don't know if supply is quite yet where we need to be. Supply and labor supply is where we need it to be just yet. So there are some kinks in the system that I think we've got to keep a very close eye on. And it is worth noting that as we think about geopolitics, just yesterday, 2 days ago, Russia did in fact announce an export ban of ammonia. So this is the exact product they put an export ban on for 2 months. So, is that going to cause food outages in Eastern Europe or Ukraine? Possibly, it could. The reason why I bring up ammonia, because obviously many of you are not necessarily in the food space, it is worth noting that those risks do reside or they are out there with regards to energy products. Make no mistake about it, Russia is a big exporter of crude oil, natural gas. They're also big exporters of alumina and aluminum, which if you remember back in late 2017, early 2018, when they were hit with sanctions, the price of aluminum jumped pretty rapidly. I think those geopolitical risks that are related to energy prices, food prices, and metals, they all are still out there. So, I hate to say we have to be watching some of these tensions within not just Russia and Ukraine, but also Iran, and they are going to have real impacts on the availability of a lot of these core commodities. And then lastly, a little bit of good news, or potentially good news. It doesn't look like much, but down here over in the very bottom right-hand corner, you can see that the Chinese credit impulse data, which is data that we've touched on for a better part of a year at this stage, it was ticking down, which historically had been a bear indicator for commodities, because ultimately China does make up a large portion of the global commodity market. It does look, and if we use history as a guide, this is roughly in the range of where you would think this chart could trough, and China could actually re-stimulate their economy with lower lending rates, decreased lending standards, things like that. And some of the data is starting to suggest that this may be yet again at the beginning of kind of a rejuvenation or a stimulative economy. There are a lot of analysts out there who are in the camp saying that China's been purposefully keeping the lid on their economy for the last 6 or 12 months, all in an effort to keep skies clear, keep pollution down, and then the hope is, and admittedly, keep zero COVID. The analyst group believes that post-Olympics, there's a very decent chance that they actually stimulate their economy, kind of flip on the pollution machine, and get their own local market going again, which I think would be supportive of commodities if that were to be how it played out. So that's what we've got on the macro side, unless Mike has anything to interrupt me with. We'll hop into the stainless side of things. Stainless continues to be in a bull trend. This is a 5-year chart looking at LME nickel prices, and we got up close to as high as about $11 per pound. That was on the back of the news announcement that Elon Musk and Tesla were taking about $1.6 billion worth of nickel in an offtake agreement over the next 5 or 6 years from a Canadian mining company. That kind of spiked the price up because it was an indication that EVs are really going to be a big driver of nickel going forward. Offsetting that a little bit, you can see this, the price jolted back down a little bit, still very much so elevated as we sit here today. But the reason for the pullback a little bit was Tsingshan, which is the world's largest stainless steel producer. They did announce earlier this month that they are beginning to produce and ship nickel matte units. So nickel matte is a form of nickel that can be utilized in electric vehicle production. So kind of offsetting a little bit of that bullishness around Tesla with the idea that they believe they will be able to help with supplying that industry a little bit. But make no mistake about it, look at this chart from a technical standpoint, from a chart standpoint, it's very much so still in an uptrend and looks pretty well supported as we sit here today. And fundamentally, it makes sense. We talked about this on Engage, but inventories on the London Metal Exchange are shown here. You can see that over the last year and a half, inventories have been dwindling at a pretty rapid clip. And again, that just centers around this idea that we're getting back to normal. We're seeing a lot of demand growth, and the supply side of things just isn't quite keeping up. So it's a similar theme to what we've seen in a lot of other metals, but exchange inventories on the London Metal Exchange are coming down pretty rapidly.
Hey, Nick, could I ask a dumb question on that one? This is always come up before, but dwindling exchange inventories add support. How does that work where, and this is, maybe just a uneducated answer on the question on this one, but like if the inventory is lower, how does that support the price? Wouldn't that?
Yeah, sure. Yeah, so ultimately, just to give a quick bit of background, the London Metal Exchange is really acts as a market of last resort, meaning if there are excess supplies of nickel or aluminum or copper, traders will actually put their metal in a certified LME warehouse, London Metal Exchange warehouse, and they're located all over the world. LME warehouses are not the only place where metal can reside. You can have other exchanges that have warehouses full of metal, and you can also have private warehouses that are full of metal. So for all intents and purposes, there are probably other trading companies that have private warehouses that have a bunch of nickel in them, a bunch of aluminum in them. They just aren't publicly tracked because they aren't forced to do so. But to answer your question, if aluminum inventories on the exchange are dwindling, there's at least a belief or a notion that if they're dwindling on the exchanges, it's likely an indication that those inventories are dwindling everywhere. Because again, that market is kind of a market of last resort. And if people are seeking out metal or nickel units from the exchange, it probably means that they couldn't really find it anywhere else, I guess is kind of the point. So we're pulling those inventories out of the exchanges, leaning things out there, which is just raises the risk or raises the concern that we could get into a shortage type situation where you actually run out of units.
Great, thank you.
And I would say, speaking of traders, this is a chart showing how investment managers and traders are currently positioned. And this is looking at it over kind of a 4 to 5 year time period. If it's below zero on the chart, it's indicative of the trading community being short or bearish the metal. If it's above zero, it's indicative of them being long. And you can see that basically since the lows of March 2020, when we were initially going into lockdown territory, ever since then, the short positioning from the investment community has very quickly gone into a bullish set of positioning. It's pretty much stayed there in bull territory or positive territory for pricing for the better part of a year and a half. So all things considered, whether we like it or not, the investment community can and does have an impact on the price of metals, and right now they're positioned pretty bullishly. Moving over to carbon, this is a slightly different chart than what we normally look at, and the difference is this. What I've got shown here in this chart is the US, we call it the HRC, so hot roll coil 5th month futures contract. Now, what does 5th month mean? Within futures land, and actually within this world, to put it very bluntly, the 5th month futures contract is literally 5 months into the future from whatever point in time you reside in. So as we sit here today in February, basically the 5th month futures contract sits out here in the month of July, and that is essentially where the market thinks steel prices are going to be in July. Now, why did I run the chart using a 5th month futures contract? There was a little bit of rationale here, and the rationale is that if we as Ryerson or a trading company or another consumer wanted to go out and import metal, there's some sort of extra lead time on getting that product into the United States from either Europe, Turkey, Russia, Korea. On average, I would say that lead time tends to be somewhere in the realm of, let's call it 4 to 6 months. So that's basically the lead time to get it on a boat, insured, to our ports, and then into our facility for processing. The reason why I think looking at a 5th month futures contract is interesting is this basically represents that lead time. So this chart that you're seeing here in the white kind of represents what the market views as the domestic competitive price against import. And what I find interesting is what the chart is basically saying is there's really going to be no economic incentive to go out and buy a foreign product, particularly from Europe, because what this is showing is the European price in blue and the Chinese price in orange. And back here, when you see these big gaps between futures prices and where the current European market is, when those gaps get really big, you start importing a lot of metal because the market is incentivizing you to do so. Fast forward to where we are today, the market's basically saying by the time that material arrives 5 months from now, there's going to be no gap whatsoever. There's no point in doing it. So why not just sit back, keep buying domestic? But I guess, translating that, what that means for the market, I think for the next couple of months, we're probably going to continue to see imports coming in at a fairly rapid clip. We've certainly seen that over the last several months, and that's because the gap was very large between U.S. prices and foreign market. Very, very quickly, though, as we talked about in prior couple of shows, the price of carbon is coming down very rapidly. And I'll give you a snapshot of what the futures are saying, but very quickly we're getting into a situation where those imports aren't all that attractive anymore. And come maybe April, May, June, I think, it's my personal opinion, because this gap is closing up so rapidly, you probably see less traders, less service centers, consumers going out and putting their necks on the line and buying foreign product. It just doesn't make sense to from a cost standpoint.
Hey Nick, on this with European, do you there's a question from the audience. What do you make of the European carbon steel market starting to see price increases from the mills? And is this demand driven or largely increased input costs? Any thoughts there?
Yeah, I guess I don't know for sure whether they're talking about kind of the carbon credit market or carbon steel. I don't follow the carbon credit market all that much, but I do think that market has been on fire quite a bit, just as they continue to transition toward green energy, making people pay to pollute. I think that market has caught on. Assuming they're talking more about carbon steel, yeah, to the extent
That's true.
To the extent that foreign carbon steel markets are finding support, I think it generally tends to act as a rising tide lifts all boats phenomenon, as does China. It turns into more of a scenario of, well, if European prices are at, let's call it $950, and there's really no reason why domestic prices should ever really dip below that, or maybe even there's an argument why prices should remain at a premium for that type of pricing. Because if European prices are going up, that just means it's going to make it even less attractive to bring in foreign product because it's got such a long lead time. Similarly, if you look at the blue line, we're looking at scrap prices here. So this is busheling scrap. We have seen that market soften a little bit in the last couple of months. And I think that's helped to fuel the fire to the downside on domestic carbon prices in the spot market. But counteracting that, interestingly enough, is the Chinese iron ore market. So you talked a little bit about some of the price support for European steel. This chart kind of suggests that there might actually be some cost plus support for Chinese prices as well, because 2-3 months ago, price of iron ore was below $90 a metric ton. It's now up about 50% from there. So we're talking about some pretty large increases, and $145 on iron ore is nothing to scoff at. That, all things being equal, does increase the cost of Chinese mills to make finished product. And again, this kind of echoes this idea that if iron ore prices remain supported and Chinese prices remain supported and European prices are seeing a little bit of price increases from the steel mills, well, then it could actually paint a picture potentially for a softer landing for domestic prices, because I think the rest of the world seeing, even if they're small, price increases, it should lessen the blow. That should provide a little bit of a cushion for where U.S. prices ultimately go. So looking at it today, I mean, I know there are some forecasts, there are some analysts out there who are forecasting 800, 700, some calling for sub $700 hot roll for back end of this year. I'll be honest, I don't see the current scenario playing out. A lot of things would have to change in order for that to play out in that way, just given the fact of where foreign markets are, where raw material markets are. It's tough for me to get there unless we go into some full-fledged recession from rate hikes or something like that. And then similarly, I talk about potential cushion for steel prices and steel markets. This is one that we haven't looked at in a little while, but this is the seasonally adjusted automotive sales. This is a U.S. figure, and the market was expecting, so just yesterday or 2 days ago, the market was expecting 13 million units, which would be indicated by basically right in here. Data came out above 15 million units. So I would say domestically within the US, the automotive industry is surprised to the upside in a pretty big way. And from what I understand, the automotive industry is working through quite a bit of inventory with regards to metal products. But there is a potential that if automotive, keeps clicking on the way they are and surprising to the upside, and maybe the semiconductor issues get put in the past, Q2, Q3 of this year, there's a potential that automotive could again lessen the blow to the downside of prices. And there are actually some analysts out there who are calling for kind of a Q2 restock from the automotive industry, which could be centered around this idea that the automotive sector is finally getting caught up with their parts, their raw materials, and that they can actually back up in a normalized production numbers, which I would say is somewhere closer to maybe 16, 17 million units per year range.
And Nick, do you know if these people are taking delivery of these vehicles now, or are they buying for like 6 months from now?
I don't have, I'm not an auto analyst, unfortunately, but I don't have that kind of color. I know that within the big three, and I'm speaking very specifically to myself selfishly, but I mean, I've been on a waiting list for the Ford Bronco for a little over a year now. and I just got a notification that that it's going to go into production later this month. So that's anecdotal, but I think that does echo what's happening with a lot of the big three, particularly Ford, because they've got a big wave of EVs that are coming out. And from what I understand, their backlogs are pretty lengthy. A friend of mine actually tried to sign up for the new Bronco just a couple weeks ago, and he was told the lead time is 2 years. So I don't know if that exactly answers your question, but I do think that some of these reservation setups that Tesla kind of introduced, I think they are getting utilized by the big three, and that's helping to create better forecasts, better foresight into what their demand is for the balance of the year.
Yeah, absolutely. Yeah, I think that's a good, maybe look into the trend, even from an anecdotal standpoint. Yep.
Yeah. And then lastly, looking at the futures, I think the trend is really, yes, we've absolutely seen prices come down at a faster clip than even the market thought 6 months ago. That 6 months ago, you look at the blue line, prices were above $1,800. The expectation was we were going to come down at a very fast rate. Fast forward to where we are today, I would say that the market declined at a faster rate than even what the futures were forecasting. You can kind of see that here, that the trajectory has been outpaced by where the futures market is now. But what's interesting as we sit here today on February 3rd, the shape of the futures curve is beginning to flatten out very quickly. Maybe not on the first couple months, because I think there's still an expectation that maybe in the next couple weeks, couple months, we're going to see a continuation of the trend that we've seen for the last 4 to 6 months, which is lower carbon prices across the board. But at some point, there's a belief that we start to hit some sort of trough. We start to hit some sort of fair value price that makes sense, and maybe gets us back to a point that we can actually start looking at fundamentals again of saying, where's the price of scrap? What's the utilization rate? And we can actually start to talk about some of those factors, because for the last year, there really weren't any indicators to look at besides just how long are lead times at the domestic mills and how many price increases they're doing, because it was name your price for the better part of the year. We're very much so not in that realm now within carbon markets, and I think it's much more of a buyer's market for now. But the good news, I don't know, I guess as we look forward, I don't want to pontificate whether it's good news or bad news. There does appear as though there's an expectation that volatility may start to dissipate as we get into Q2, Q3, Q4, and that the range of prices may start to tighten a little bit, which I think would probably be a welcome surprise for not just Ryerson, but for our customers to take out some of that volatility.
Hey, Nick, before you move on from the carbon, we got a question here from the audience. What effect will the falling HR coil market have on plate? So the question about plate, from coil versus plate. So like we talk a lot about, the coil and the sheet, but what kind of impact does that have, falling prices on plate?
It doesn't necessarily have to have any direct impact, because you can make the argument that plate markets are just a different end use market than coil markets. But I would say, generally speaking, when you think about just the manufacturing industry, entities and industries that are using coil are probably also using plate. So there tends to be a relationship between the two. The relationship, we've talked about this in prior months, the relationship tends to be carbon sheet prices and coil prices tend to lead plate prices by a couple months. And right now we're seeing plate prices in excess of coated and cold roll market. And I just don't think that phenomenon is going to last too much longer. Again, that's a little bit of my opinion, but generally speaking, on a historical basis, plate has lagged carbon flat roll by a couple months. So if we were to think that relationship holds true, then maybe a lot of these things we're seeing within carbon flat roll, carbon sheet, we start to see it to some degree within the plate market.
And I guess on that, are we still seeing the big price gap between hot rolled and cold rolled?
We are for now. And again, I still fully anticipate that spread to converge, because I've mentioned this in the past, but there is certainly an economic incentive for anybody who has re-rolling capacity to take a coil of hot roll, run it back through a facility, sell it as cold roll, because the spread right now is far in excess of what the cost to do so is. So I would guess that that's very much so on the radar of a lot of the steel mills and re-rollers, and I think for that reason, as we roll through time, we'll see that convert, because there isn't really a fundamental rationale as to why it should be $500, is where the hot roll versus cold roll spread is. Lastly, switching over to the aluminum side of things, this chart looks fairly similar to the nickel chart, which is markets are very well supported. We're in a very, very strong uptrend. I touched on the slide that was correlating aluminum prices to crude oil. It's not a perfect correlation, but it's certainly, and it echoes this idea of rising energy prices for a product like aluminum that's very energy intensive. They tend to be positively correlated with one another. So as we're seeing crude oil above $90 a barrel, you've got natural gas in Europe at $27 per MMBTU. Those things are going to have additive effects to the cost structure of aluminum. So I do think that there's a little bit of a geopolitical risk priced into the aluminum market as well, where I think a lot of people are having flashbacks to 2017, 2018, when the US issued sanctions on Rusal and the price of aluminum just went absolutely crazy. I think some of that risk is still priced in. So until or unless we get the tensions between Russia, Ukraine under control, you probably continue to see that premium built into the pricing. If the tensions dissipate a little bit, I would tend to think that energy prices probably give up a couple bucks, and you probably see a little bit of deflation within the price of aluminum as well. And similarly, similar to what we did on the nickel side, this is looking at the exchange inventories of aluminum ingot. And you can see we're certainly at 5-year lows. If we extended this back, it probably take us back about 6 to 8 years since we were down at these levels. And for those who can't see it, it's about 782,000 units of ingot or metric tons of ingot. So things are certainly lean, and markets are tight on the base metals world with regards to aluminum and nickel for sure. And then lastly, on the investment management community. So again, this is looking at a similar chart of saying how bullish or bearish is the investment community. Very similar story to what we saw in nickel, which was that there was ample bearishness going into the lockdowns and all of that. And then there's very much so a very bullish trend. And that bullish trend has not only really maintained, but it's even ramped up a little bit. And maybe you could attribute this little bolt higher to probably a little bit to the energy move and probably a little bit to the geopolitical tension with Russia, Rusal, those types of risks. So again, there's a lot to watch, and it is all interconnected. But I really do think 2022 is going to be the year where we start to revert back to people getting back into their jobs in a fairly normal way, helping to loosen up some of these supply chains, but really getting back to the core of making things and producing things with fundamental building blocks of our global economy, which is for now fossil fuels, base metals, ferrous metals, things we've got to take out of the ground. And I know that may not be a popular opinion. I don't think this narrative of snapping our fingers and going into a wind-based, solar-based world is as easy as that. I think it's going to take a little more time, and I think over the long run, I think this should be good news for the manufacturing sector, experiencing some growth in 2022. But with that, that's what I've got.
Yeah, I would kind of dovetail off of that, saying, right, I mean, you got the infrastructure bill kicking in and some projects coming online later this year and into 2023. When you speak about the year of creating things and building things, I think that can't be ignored, and there's a lot to be said. And like you said, pulling the metals out of the ground and creating things and showing up physical infrastructure, I think is something on the agenda for sure. I'm going to park you here on aluminum, and there's a question here about can you explain the relationship between aluminum pricing and aluminum scrap pricing?
Sure. I mean, the two should be pretty well interrelated. I do know that on the scrap side of things, a lot of scrap yards do actually price their product, whether they're purchasing or selling. They price their product as a benchmark to LME aluminum prices. So in a lot of cases, it may not be one for one, but it's kind of pro rata based. So maybe I'm making up numbers, but it's based on percentage of whatever the LME aluminum cost is. So there should be a very, very strong relationship between the aluminum pricing you'd see out in the market, whether it's contractually set up by the LME or if you're just paying market rates. There should be a very strong relationship.
Great, thank you. And this question came in right at the end, and I assume this was onto your last slide when you were talking about the investors in aluminum. You said bullish. When you say bullish, do you mean that investors are holding onto their inventory?
Holding on to long contracts. So in this case, it would be akin to, if you think the price of Apple stock is going to go up, you could go out and buy Apple stock. Similar process here where this is an indication of how many contracts of aluminum the investment community is holding or basically positive on the price, the expected price move. So yeah, bullish would be an indication of them expecting prices are going to go higher. That could be for fundamental reasons. They think that the market is tight and there's going to be more demand than supply. It could be a function of, and this does happen as well, the investment community does sometimes hold commodities as an inflation hedge, because as some of our viewers may know, when inflation tends to pick up, things like base metals, gold, silver, tend to perform better as well. So there's a bit of a macroeconomic trade that's possible as well. But whatever the reason, the investment community is pretty positive on the price outlook for the commodity looking forward.
Great. We'll rewind back to stainless. Got a few here. What's the outlook for nickel inventories increasing by the summer? Do you anticipate that?
The trend certainly isn't looking that direction. And again, I think you sprinkle in the fact that on a global basis, there are a lot of economies that are beginning to lift restrictions. And again, I'm not trying to come out and say official end to COVID or Omicron or anything like that, but from a policy standpoint, it certainly looks like there's some nations that are creeping back towards normal, and creeping back towards normal probably means demand of a lot of things. And so I don't think the demand side of the equation is ready to falter just yet. And for that reason, I would say probably more of the same, at least for the first half of this year. The stainless markets look pretty strong, where I sit.
Okay, and on that, does the strong correlation between nickel prices and stainless prices still exist?
It still exists. There's a perfect correlation between the stainless surcharge and the underlying commodities because it's completely formula based. With that said, the formula is going to be dependent on the grade of stainless. So if the grade of stainless doesn't have any nickel in it, then there'll be no relationship whatsoever. But there are certain grades of stainless, obviously 300 series, 200 series has nickel in it. And in those cases, there will absolutely be a portion of those price movements for stainless that will be tied back to nickel. Now, in addition to that, you also have the base pricing component. And I apologize if I'm insulting anybody's intelligence. The base pricing component is much more a function of supply, demand, availability, supply, demand dynamics within the stainless industry. So that's going to be more set by, well, not more set, it's purely set by the stainless mills who are supplying that metal out in the market. If they see things as being tight, which they have over the last 18 months, they'll announce base price increases. And the most recent round of that happened in the last 45 days, where both Outokumpu and North American Stainless announced base price increases. So the base pricing side of things doesn't really have to have anything to do with nickel prices.
And one final one, I'm going to bounce you back to aluminum. I believe this says, what do you see as a relationship between, looks like aluminum and aluminum alloy?
So should be quite strong. I am not an aluminum alloy expert. I tend to watch, so like NASAC, I think maybe what they'd be referencing, but I would say generally speaking, there should be a very strong relationship between aluminum, common alloy aluminum and all of the sub-products, because they're all trading off the same raw material complex. There might be small deviations, but I would say the correlation would be quite good.
And I lied, I got one more here. Lead times at extrusion mills are starting to push out more and more. Have you heard anything about what might be causing lead times to extend for extrusion mills?
I don't have specific detail, but that would be one, Mike, that I would say we should follow up on and get one of our product managers involved with, because that'll be much more in the wheelhouse of discussions they're having with our mill supplier. So I think we can follow up with that one.
Great. As always, great stuff here. There's questions to continue to roll in here, and we can answer those as best as we can. But I thank you for joining us Again, this is the first Thursday of every month. There'll be a complete recording on our YouTube channel tomorrow. And be sure to sign up. Once you sign up in the link, you sign up for all of them in a year. Without further ado, Nick, I'll give you the closing thoughts here.
You know, I think who can say it better than Kanye West? I know the guy's had some interesting things going on in his life over the last couple of years, but I think when it comes to his most recent note on Instagram, I think we all need to take heed and build things in the physical world, and let's make it a great 2022 for everybody. We appreciate everybody's time.
Thank you all.